Good afternoon. This is Blake Young for the TheoTrade evening video for Thursday, January 26, 2023. And today we're talking about good news becomes good again. So let's take a look at the data here. First, by looking at how the market responded to positive economic data. Then we'll get into the positive economic data and maybe a little bit of warning of what might slow down this positive move. We've rallied off of the lows back in December and then got stuck. We've been stuck in this area of overbought, oversold for about 3 weeks. And really, even this area, we've been trading within a matter of a percentage for over 2 weeks. Today, finally, we got a gap up, close higher, and closing near the high. This is a solid breakout with the gap up, close higher, and closing near the high, plus on average to slightly above average volume. This is a win. And this win happened arguably because we had really good economic data. Economic data included advanced GDP. GDP, gross domestic product, is the broadest measure of health in an economy, and advanced GDP is considered the more influential, more significant GDP, as it is the earliest and most predictive of the GDP reports. And so we can look at this and say, we're not only doing well, we're doing better than expected and better than predicted, and in line with the last quarter, showing solid growth near 3%. This is a good sign that we are not heading into recession this first quarter, second quarter, and probably not even by the third quarter, based off of this quarter being a solid 2.9% growth. That's a big win. And it opens the door for the idea of a soft landing, even with raising the rates. That even if we need to raise rates a little bit more, the economy is growing, and therefore we're not facing a recession. Secondly, we had durable goods orders. These are your longer term duration or durable items like dishwashers and things like that, your appliances, and that increased from a negative 1.7 to a positive 5.6. That is a sign of confidence in the economy that individual consumers are buying stuff and buying big ticket items. Additionally, the weekly unemployment claims dropped again. So unemployment is now facing a dip here in weekly unemployment claims, which is arguably an indication that we're going to have even higher employment numbers in February. So another big win. And then lastly, new home sales. This was a little bit of a surprise for me in that we saw new home sales push higher. With the interest rates rising, we saw a little bit of a dip in the 10-year Treasury yield, and this is a little bit of a bounce in the new home sales from month over month, which is giving us an indication that maybe those home sales or home builders like D.R. Horton, Toll Brothers, KB Homes, Pulte Homes are going to be able to liquidate their inventory, that there still is demand, and the interest rates on the 10-year Treasury yields are low enough that people are still buying new homes and contracting to buy new homes. And we were a little bit worried about that based off what we're seeing going on in the mortgage and applications and contracts. But apparently that's not as big of a concern. Additionally, we will see some inflation data, the inflation data that is used more exclusively by the Fed than even CPI, and that is this core PCE price index. That stands for personal consumption and expenditure. So this is a big number, and it's expected to go up a little bit, but not significant enough to get us worried about inflationary prices. And if new home sales improved, we're hoping that pending home sales improved, and then obviously consumer confidence should be on the rise. Everything appears to be good news. Good news is good news again. However, here's the concerns we have. When we look at that 10-year Treasury that seems to be driving the confidence to continue to buy homes and buy new homes and build, we are still facing an inverted yield curve. This is from the Treasury Department, the treasury.gov, and you can see that we've had a 4.7, 4.74, 4.75, 4.8, 4.85, and that's all in the shorter time frame. It's a 1 month to 1 year. We've had 4.6 or higher. While if we go out to the 3-year, 4-year, 5-year, 7-year, and 10-year, and this is where the home mortgages reside, they're at 3.5 to 3.46. So this is good news for home builders. This is good news for people wanting to buy homes, because this rate of 3.5 or 3.46 would infer about a 2% higher rate for your mortgage, which means that you might be able to get a 5.5% mortgage right now, which is cheap. It's inexpensive. When we saw it go up to 6.5%, 7%, even 7.5%, that was becoming a little bit more restrictive to buy homes. Well, this number is helping that out. The difference is this is still an inverted yield curve. And it's been an inverted yield curve for a very, very long time. And I'm going to show you one other website, and then we're going to get into a couple of sectors that shows us what do we need to do in an inverted yield curve. Right now, the news is good. We still show growth. That's good. But if you were to look at the San Francisco's Fed data on inverted yield curves, they would tell you that after an inversion, it can be 6 months to 2 years after an inversion before we see the economy correct, the S&P fall, and really even a potential recession. So we still have time. Let me show you this nifty little tool here, and you'll be able to see down in this corner, it'll change from normal to flat to inverted. And I want you to watch this side as the line moves along there to match up to the S&P 500, in this case the SPX. So I click on animate, and you're going to watch as this yield curve starts to flatten as we get into the late 90s, and you'll see this right through here. It's going to go into inverted right there. There went flat and flat, normal to flat, normal to flat, normal to flat, and then it inverted right there in early 2000, right about 8 months to a year before the peak of the market. And then from that point, everything started falling. And you notice that was always inverted on this side. So if we continue to watch this data, that inversion corrected itself and got back to a normal chart, not just a month, not just 6 months, not just a year, but 2 years before we finally bottomed out in the market. So the market can turn, and the recession can have the impact, the inverted yield curve can have an impact, and it can take quite some time after the yield curve corrects itself before the market finds a base. Now let's jump forward to see what it did here in 2007, 2008. Now you notice we went flat on the yield curve, warning us as early as March and April 2007, but we inverted as we went right into 2008, 2009. And that was what we saw setting up for this big crash. Now, again, we've already normalized, and it's another 2 years before the market found its base. 2 years from when we normalized before that market found a base. Now, as we watch here, we can move this along a little bit quickly because we didn't really have a lot of inversions. We didn't really have anything go flat. You can see as I'm jumping forward really fast, covering, there's 10 years right there. As we're watching it, watch the red line. We want to watch to see when does it go flat, when does it invert. And so as we're watching it, we're seeing it gets closer and closer. Where does it invert? Where does it invert? Here's 2021. We're now in December. Here's January 2022, and we're starting to flatten. There's flat. So we went flat in March of 2022, and we went inverted. There's another flat. There it went. There it was. We saw the inversion. Our first inversion, if I can get it right there. There we go. Our first inverted yield curve was in August, at least based off of this dynamic yield curve chart. So in August, if that was the starting point, that doesn't mean that was the peak of the market. Doesn't mean that we can't go higher, but it's just kind of the starting point of the inverted yield curve. And it's not a perfect guarantee. It's an indication that long-term lending does not, there's no benefit to long-term lending because there's no benefit to long-term investing. So when we get a better yield in 3 months and 6 months than we do in 10 years, there's no incentive to invest in the long term. And that's when we're going to find some new sectors that we may want to invest in as we're watching it invert. It doesn't mean the market's going to go down. It means that we could see 6 months to 2 years of it continue to climb. And then after it normalizes again, we could see 6 months to 2 years of a continued dip in the economy and in the market. So continuing this forward, just so you can see what's happened over the last 5 months, watching this continue to move, maybe. Well, I'm just going to have to move it by hand, apparently. And here we're just resetting back there a couple months so you can watch this flat. There's inverted, flat, inverted, flat, inverted, 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 inverted. Here we are inverted from August all the way through to our current time frame. Then it just popped back over to 1999 to start over. But really, we are sitting on an inverted yield curve, and we've been inverted for 5 months. So there's still time, is what I'm getting at. There's still time that this inversion can have the pressure to put the market into a pullback. Now, that's not a reason to be nervous or uncertain. It just means we may want to look at different sectors for opportunities. Historically speaking, when the yield curve inverts, financials actually don't do well. So the discussion has been lately that, hey, financials do well as you're raising rates. And financials have done well while we've been raising rates, but the inversion is the issue. If the inversion stays inverted, then the banks have a hard time making money on a longer time frame because the interest rates in the short term are so high. And if they're so high that the banks have to borrow at a higher rate than what they're lending, that becomes difficult for the banks to create more money. So there'll be an opportunity to short or sell banks, but there's also going to be opportunities to buy insurance. Insurance companies tend to do well in an inverted yield curve type of environment. So if we're taking a look and say, maybe we need to start looking for finding tops in companies like JP Morgan, where with today's breakout, JP Morgan has stayed stuck. We could look at things like Morgan Stanley and Goldman and Citigroup and say, okay, is this going to be the top? Even with that breakout in the broad market, you can see we paused, and that was not a breakout. We didn't clear the high in Citigroup. Goldman Sachs and Wells Fargo, they're not even getting up to that high. And so there should be opportunities to short or go bearish on Goldman, on, like I said, on Wells Fargo, on any of these financials, while also saying, well, in these inverted markets, we might want to start looking for opportunities to buy breakouts on companies like Travelers. Travelers has done great and has been able to maintain its growth and really hasn't been much of a risk situation. We take a look at companies like Marsh & McLennan, and Marsh & McLennan had a phenomenal day today, solid breakout. I would even argue this is kind of a cup and handle, and there may be an opportunity for another 10 to 15 point move on Marsh & McLennan. A couple of other industries, and I'm not saying sectors, I'm going subsector into the industries, and just like we did with insurance instead of banks in the financial sector. If we go to healthcare, healthcare is a defensive sector, but the healthcare sectors have done well during a defensive time frame, but healthcare equipment companies have done really well during an inverted yield curve. So we might take a look at something like a ISRG and find a bounce here as a positive indication after earnings that they may be doing better in the future and could be bouncing and moving back up to 270 or higher. So I'm going to be taking a look at ISRG and Medtronic and some of the other companies for bullish moves as they are discounted. And if we remain in an inverted yield curve, healthcare equipment companies have a tendency to do fairly well. The last ones that we might want to look, well, that's going to include industrials today, but instead of industrials, let's take a look at food. I've discussed consumer staples being a defensive sector, and there's going to be opportunities to sell premium against these. But we also know that inflation has been double digits in food. We will continue to buy that food even when it is double digits. So as that inverted yield curve stays, and then we see the recession or the pullback, when we see disinflationary pressures, food companies and tobacco companies should have a significant edge as well. Take a look, for example, at PG, Procter & Gamble, from the household products. And we've seen a lovely bounce on these lows. It hasn't continued, but they outperformed, even though it's not showing here, they outperformed earnings and then became a even more discounted rate. I actually like PG as an opportunity to buy or at least sell puts to collect that premium. Additionally, I am intrigued by the gap down from McCormick. McCormick missed earnings and still performed better than the previous quarter, but missed analyst expectations. But again, performed better than the previous quarter, and this seems to be an overshoot. If we outperformed the previous quarter, even though analysts had a retest of the annual lows, or at least annual support level, on a higher quarterly rate for a food and spice company, I think there could be a discounted purchase price for companies like McCormick, and therefore maybe selling puts. Last one we're going to look at is we'll go to Philip Morris. Tobacco companies have also been a defensive sector, and tobacco companies aren't following food, they're following the broad market. And you can see Philip Morris is breaking out, closing up to these highs, and really kind of pushing the top channel of a potential breakout. And if it does break out, we might call this a channel and look for about a $6 to $8 move, which is 5% high. And just as a reminder, Philip Morris is absolutely a M&E multinational enterprise. It is one of the largest multinational corporations in the world and has exposure in Europe and Asia, East Asia, more than it does in any other part of the world. And so Philip Morris is an opportunity to divest from just the U.S. markets, but also play into all the markets as a potential bullish play or a potential profit-based play off of selling premium to see if it's going to break through the highs. And if you don't want to have that exposure to the tobacco industry, you can always go off the original juggernaut and take a look at Kraft, as Kraft was once part of the Philip Morris umbrella, and focus on the food side of things and look for buy opportunities, bounces, or at least selling premium down here at $40, because I do believe this is a discounted rate as well for someone like Kraft. All right, that's going to do it for us today. Join us again next week. Have a great day, everybody, and thanks for watching.